What if I told you that the amount you spend on coffee every week could make you a millionaire? I'm serious. $25. That's it. Less than a streaming service subscription, less than a few fancy lattes, less than one Friday night takeout order. In 45 years, that becomes $1 million. And here's the crazy part. The strategy is so simple, it's almost boring, which is exactly why it works. Now, I know what you're thinking. I don't have enough money to invest. I'll start when I make more. That's the excuse that keeps people broke their entire lives. Because here's the truth. You don't need to be rich to invest. You need to invest to become rich. And by the end of this video, you're going to have the exact blueprint that thousands of everyday people are using right now to retire as millionaires. So let's dive in. This strategy has two secret ingredients, and they're not actually secret at all. They're called dollar cost averaging and compound interest. Now, if those sound boring, good. Boring makes money. Exciting loses money. Let me explain what these actually mean in plain English. Dollar cost averaging is just a fancy way of saying you invest the same amount regularly, no matter what's happening in the market. Market up? You invest. Market crashing? You invest. Your cousin telling you the world is ending? You invest. This removes all the emotion and guesswork from investing. And compound interest? Think of it like a snowball rolling down a mountain. It starts small, but as it rolls, it picks up more snow, gets bigger, and starts moving faster. Eventually, it becomes unstoppable. Here's what your journey actually looks like with $25 a week. After 10 years, assuming a 10% average annual return, you'll have $21,718. You only put in $13,000 of your own money. After 20 years, you're looking at $78,050. You only contributed $26,000. After 30 years, things start getting really interesting. You've got $224,159 and you've only invested $39,000 of your own cash. But watch what happens next. After 40 years, you're sitting on $603,129. And then, at the 45-year mark, you hit $979,665. You're a millionaire. Here's the part that blows my mind every single time. Over those 45 years, you contributed $58,500 total, but you earned $941,500 in interest. The money made more money than you ever could working a regular job. That's the power we're talking about here. So how do you actually do this? You need to invest in something, right? And this is where most people get overwhelmed. They think they need to pick individual stocks, time the market, become a finance expert. Wrong. You need 3 letters. ETF, exchange traded funds. Think of an ETF like buying a slice of the entire market in one simple transaction. Instead of trying to pick the next Apple or Amazon, you just own all of them at once. Based on the latest data from October 2025, there are 4 specific ETFs that are dominating this strategy. Let me break down each one, and I want you to think of these as your weapons in building wealth. ETF number 1 is VOO, the Vanguard S&P 500 ETF. This is the powerhouse, the workhorse, the reliable beast that just keeps performing. VOO tracks the 500 largest companies in America. We're talking about the absolute cream of the crop. As of right now, it's trading at $615.25 per share. But here's the beautiful part. You don't need to buy a full share. Most brokerages let you buy fractional shares, so your $25 goes right in. The fees on this thing? 0.03%. That means for every $10,000 you invest, you pay $3 a year in fees. Compare that to actively managed funds that charge 1 to 2%, and you can see why this matters. Over decades, those low fees save you tens of thousands of dollars. Last year alone, VOO returned 24.98%. Over the past 10 years, it's averaged 14.6% annually. And since inception, it's delivered 15.1% annualized returns. When you own VOO, you own NVIDIA at 7.33% of the fund, Microsoft at 7.04%, Apple at 5.83%, Amazon at 3.94%, and Meta at 3.05%. You're literally owning pieces of the companies that are shaping our world. The sector breakdown is 33.5% information technology, 13.8% financials, 10.6% consumer discretionary. This is your growth engine. ETF number 2 is VTI, the Vanguard Total Stock Market ETF. If VOO is the top 500 companies, VTI is everything, and I mean everything. This fund holds 3,526 different securities. Small companies, medium companies, large companies, growth stocks, value stocks. You own approximately 100% of the investable U.S. stock market with one purchase. Right now, VTI is priced at $329.79 per share, with the same ultra-low fee of 0.03%. This year alone, it's up 13.8%. Last year, it returned 17.51%. The 5-year average return is 15.8%. The sector allocation is similar to VOO, but slightly more diversified because you're getting those mid-cap and small-cap companies too. Technology is 32.53%, financial services 13.82%, and it spreads out from there. Here's how I think about the difference. VOO is like owning the New York Yankees. You get the superstars. VTI is like owning every baseball team in America. You get the superstars plus everyone else. Both strategies work. Many investors actually use both or choose one as their core holding. ETF number 3 is SCHD, the Schwab US Dividend Equity ETF. This is your income generator, and it's a completely different beast. Right now, it's trading at just $27.34 per share, making it super accessible for weekly investing. The expense ratio is 0.06%, still incredibly low. But here's where it gets interesting. The dividend yield is 3.81%. What does that mean? It means the companies in this fund pay you to own them. Every quarter, you get cash deposited into your account. And if you reinvest those dividends, which you absolutely should, you're buying more shares, which pay more dividends, which buy more shares. It's compounding on steroids. The latest quarterly dividend was 26.04 cents per share, and over the past 5 years, these dividends have grown at a compound annual growth rate of 10.38%. The companies in SCHD are dividend aristocrats, companies with long track records of consistently paying and growing their dividends. You've got AbbVie at 4.59%, Merck at 4.26%, Amgen, Lockheed Martin, Cisco, ConocoPhillips, Verizon, Chevron. These are stable, mature, cash-generating machines. The 10-year return on SCHD is 12.3% annually. Over time, this fund has proven that dividends aren't just nice to have. They're a massive driver of total returns. ETF number 4 is SCHY, the Schwab International Dividend Equity ETF. This is your global diversification play. It's priced at $27.51 with a 0.08% expense ratio and a 3.89% dividend yield. Why do you need international exposure? Because America isn't the whole world. If you only invest in U.S. stocks and the U.S. market underperforms for a decade, you're stuck. SCHY gives you access to dividend-paying companies across developed international markets. The dividend growth on this fund has been impressive. 30% growth since 2022. This year, it's up 10.5%, and the 3-year return is around 12.9%. The current yield is 4.5% with forward yields approaching 5%. Think of SCHY as your backup plan. If international markets outperform U.S. markets in the coming decades, you're covered. Now let's talk about what your actual journey looks like, because I need you to understand the emotional roller coaster you're about to get on. There are 2 scenarios we need to consider: conservative and moderate. The conservative scenario assumes 7% average annual returns. That's on the lower end, but still realistic based on long-term market history. The moderate scenario assumes 10%, which aligns more closely with historical stock market averages. Let's walk through the conservative path first. You start investing $25 a week. After 10 years, you've got $18,571. That's not bad, but it's not life-changing either. You might look at that number and think, this isn't working fast enough. This is where most people quit. Don't be most people. After 20 years on the conservative path, You're at $55,103. Now you're starting to see real money. After 30 years, you hit six figures. $126,966. After 40 years, it's $268,332. You're well on your way, but you're not quite at $1 million yet. On the conservative 7% path, you hit $1 million at year 58.7. That's almost 59 years of consistent investing. Now let's look at the moderate 10% scenario, because this is where the magic really happens. After 10 years, you've got $21,718. Still modest, still requiring patience. But watch what happens next. Year 20, you're at $78,050. The snowball is picking up speed. Year 30, you explode to $224,159. You've crossed $250,000. Year 40 is when things get absolutely insane. You're sitting on $603,129. You can taste the million. And then at year 45, you hit $979,665. You're a millionaire. Here's what I need you to notice. The first 20 years feel slow. You're putting in money every single week, and the returns seem almost disappointing. Your friends are buying new cars, going on fancy vacations, and you're just watching your investment account slowly grow. This is the test. This is where discipline beats intelligence every single time. But look at what happens between year 30 and year 45. You go from $224,000 to almost $1 million. That's $755,000 of growth in just 15 years. Why? Because compound interest is finally doing its thing. The money is making money, which is making more money, which is making even more money. Your contributions almost become irrelevant at this point. It's the compounding that's driving the growth. The hardest part of this entire strategy isn't the math. It's not picking the right ETFs. It's not understanding expense ratios. The hardest part is staying consistent for 45 years. No panic selling when the market crashes. No stopping contributions when times get tough. No getting impatient when your buddy tells you about some crypto that's going to make you rich overnight. The market will crash. It always does. In those 45 years, you'll live through multiple recessions, market corrections, and probably a few times when people are screaming that the sky is falling. Your job is to keep investing $25 every single week like nothing is happening. All right, let's talk about the fine print, because I'm not going to sit here and pretend this is perfect or without challenges. Let's start with the good news. All four of these ETFs have ultra-low fees. VOO and VTI are 0.03%. SCHD is 0.06%. SCHY is 0.08%. These fees are 10 to 20 times lower than actively managed mutual funds. Over decades, that difference is hundreds of thousands of dollars staying in your pocket instead of going to fund managers. These ETFs are also tax efficient. They pay quarterly dividends, which gives you predictability for tax planning. And the ETF structure itself is more tax efficient than mutual funds because of how shares are created and redeemed. You can automate the entire process. Set it and forget it. Once you set up automatic weekly investments, you literally don't have to think about it again. Now here come the challenges, and I want you to hear these so you're prepared. First, there's market concentration risk. As of October 2025, technology stocks make up 33.5% of VOO's portfolio. That's the highest level in decades. The top 10 holdings represent 36.6% of the entire fund. What does this mean? If the technology sector crashes hard, you're going to feel it. This is exactly why diversification across all four ETFs makes sense. You spread out that risk. Second, let's talk about the time factor. If you're 25 years old and you start this strategy today, you'll be 70 when you hit that million. That's a long time. If you're 40 years old starting this strategy, you'll need to either invest more than $25 a week or accept that it might take longer than 45 years to hit $1 million. Time is your biggest advantage when you're young, and your biggest enemy when you start late. But here's the thing, it's never too late to start. A 40-year-old who starts investing will still be way better off at 65 than someone who never started at all. Third, we need to talk about inflation. $1 million in 45 years will not buy what $1 million buys today. Assuming a 3% annual inflation rate, that future million will have the purchasing power of about $237,000 in today's dollars. Does that mean this strategy doesn't work? Absolutely not. It means you need realistic expectations. $1 million in the future will still be life-changing wealth. It will still give you options. It will still beat the alternative of having nothing saved for retirement. Finally, let's talk about how to split your investments across these 4 ETFs. There's no perfect answer, but here's a balanced approach that makes sense for most people. Put 40% into either VOO or VTI as your growth engine. Put another 40% into SCHD for income generation and dividend growth. Put the remaining 20% into SCHY for international diversification. This gives you domestic growth, dividend income, and global exposure all in one simple portfolio. Here's where we are. Right now, at this exact moment, someone watching this video is making excuses for why $25 a week is too much. They can't afford it. They'll start next month. They'll start when they get that promotion. They'll start when they understand investing better. And right now, someone else just paused this video, opened up their phone, and started the brokerage account sign-up process. 45 years from now, one of these people is going to be a millionaire. The other is going to be in the exact same financial position they're in right now, maybe worse, wondering where all the time went. Which one are you going to be? Don't wait for the perfect time to start investing, because there is no perfect time. The market is always either too high or too low. The economy is always either too good or too bad. You're always either too young or too old. These are all excuses dressed up as reasons. The best time to start this strategy was 45 years ago. The second best time is right now, today, this moment. Start with whatever you can. If $25 a week feels impossible right now, start with 10. Start with 5. The specific amount matters less than building the habit of consistent investing. You can always increase it later. What you cannot do is get back the time you waste waiting for perfect conditions that will never come. This isn't about getting rich. Let me be very clear about that. This is about buying freedom. Freedom to retire with dignity instead of depending on Social Security that might not be enough. Freedom from lying awake at night worried about money. Freedom to live your life on your terms instead of being controlled by financial stress. That's what this $25 a week is really buying. Not just money, freedom. If you found this valuable, do me a favor and hit that like button. Subscribe to the channel if you want more content about building real wealth without the hype or the nonsense. And drop a comment below telling me what your biggest obstacle is to starting this strategy. Is it fear? Is it confusion about which ETF to choose? This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.